The investor who made billions predicting the 2008 collapse just shut down his hedge fund. On November 10, 2025, Michael Burry's Scion Asset Management officially terminated its SEC registration. This isn't just another fund closure. This is the man who saw through the subprime mortgage scam when everyone else was buying, who made over $100 million while banks collapsed around him, walking away from the game entirely. Before we go any further, remember this. When a man who made billions by seeing what the rest of Wall Street couldn't suddenly packs up and walks off the field, it never means nothing. If you're still here, click Keep Watching, because this part sets the entire stage for what comes next. Michael Burry didn't just close a fund. He stepped away from a system he says no longer reflects economic reality. On November 10, 2025, Michael Burry's Scion Asset Management officially terminated its SEC registration, ending its life as a public hedge fund. And Burry wasn't cryptic about why. In a letter dated October 27th, he told his investors that the way he values securities is not now and has not been for some time in sync with the markets. Think carefully about what that implies. The same man who dissected the subprime mortgage machine while the rest of the world celebrated rising home prices is now saying the numbers simply don't add up anymore. Not that they're distorted, that they're impossible. But the real puzzle lies in his final disclosed positions. In Scion's last 13F filing for Q3 2025, Burry was sitting on an enormous stack of bearish bets, $912 million in put options on Palantir and $186 million in puts on Nvidia. These aren't tiny hedges. These are moonshot wagers against two of the most worshipped names in the AI boom. And these options don't expire next quarter. They stretch into 2026 and 2027, a timeline that reveals what Burry truly believes. This isn't a quick correction. It's a multi-year unraveling. His reasoning is even more alarming. Burry has openly accused major tech firms of manipulating depreciation accounting on their AI infrastructure, spreading hardware costs over unrealistically long periods to artificially boost earnings. That's not hyperbole. That's a claim that billions of dollars worth of reported profits may be built on accounting smoke. For a man who only speaks when he's certain, these are seismic words. Then comes the twist. Instead of staying in the spotlight, Burry is shifting Scion into a family office structure. No more public filings, no more 13Fs, no more visibility into what he's buying or shorting. He's going silent right as the market hits record highs. And just before disappearing, he left one final message on Twitter: on to much better things. Then, nothing. What makes this moment feel like déjà vu is simple. This is only the second time in his entire career he has walked away from the market while prices were still climbing. The first time was 2008, right before the financial architecture of the United States nearly collapsed, back when people mocked him for betting against mortgages, and then watched him walk away with gains that seemed impossible. Today feels eerily similar. The S&P 500 is hovering near its peaks. AI stocks look unstoppable. And yet the man who called the last great crash is leaving because he says rational profit is no longer possible. That's not a statement about him. That's a statement about the market itself. Here's the part almost nobody pays attention to, but every crash in the last century has whispered the same warning before the fall. If this already feels familiar, tap Continue, because what you're about to hear is the pattern legend saw long before the crowd did. History never repeats perfectly, but it leaves fingerprints. And the most chilling of those patterns is what happens when the smartest investors allied quietly step away from the market. Every major collapse in American financial history was preceded by a master stepping back, shaking his head, and saying some version of the same thing. This isn't real anymore. The first and most iconic example is Jesse Livermore. By 1929, he wasn't just a trader. He was a phenomenon. The man who made $3 million shorting the panic of 1907, back when $3 million could practically buy a city. But by late September 1929, while Americans were celebrating the roaring markets and the illusion of endless prosperity, Livermore was doing something unthinkable, closing all his long positions and preparing to bet against the entire system. His associates thought he'd completely lost it. Stocks had been climbing for years. The Dow had tripled since 1924. Every newspaper declared a new age of prosperity. But Livermore wasn't reading headlines. He was reading numbers. And the math showed something insane. Stock prices had broken away from company earnings so violently that collapse wasn't a possibility anymore. It was an inevitability. October 24, 1929, proved him right. The market cracked. By 1932, it wasn't just down, it was obliterated, collapsing 89% from its peak. Millions of Americans lost everything. Livermore, who saw the fracture forming, walked away with a profit equivalent to more than $1 billion today. He wasn't lucky. He recognized the distortion early, and he acted before anyone else understood the danger. Fast forward to March 2000, and the same pattern played out in a different costume. Julian Robertson, the man behind Tiger Management, had one of the most extraordinary track records in hedge fund history. 20 years of compounding at 31% annually. Institutions begged to invest with him. He could have managed money forever. But then something strange happened. At the peak of the dot-com frenzy, Robertson shut his fund down completely. Not trimmed, not paused, shut down. And his letter didn't hold back. He wrote that the tech and internet mania bore no resemblance to rational investing. He couldn't and wouldn't compete with a market that had abandoned fundamentals for fantasy. The reaction was brutal. CNBC called him outdated. Tech CEOs mocked him. Retail investors sneered at him from chat rooms, insisting this time was different. 1 month later, the Nasdaq hit its all-time high of 5,048, and then the bottom fell out. By 2002, it had crashed to 1114, a 78% wipeout that erased $5 trillion in wealth. Companies that had spent millions on Super Bowl ads were suddenly worthless. Pets.com didn't disrupt anything. It simply disappeared. Robertson wasn't wrong. He was early. And in markets ruled by momentum instead of math, early looks like wrong until reality snaps back. That's the core of this chapter. Legends don't exit because they're burned out or scared. They exit because they recognize the same mathematical impossibility that Livermore saw in 1929 and Robertson saw in 2000. They step out when the game stops being a game of skill and becomes a carnival run by hype. And every time they've done it, the crash has followed. Here's the part most people still can't wrap their heads around. Michael Burry didn't fade into quiet retirement. He didn't sell his positions, thank everyone, and walk off into the sunset. He shut the entire machine down. A full regulatory termination, sudden, final, and executed with the precision of someone who knew exactly what he was doing.
And before you think this was just another fund closing like the ones that happen every year, stay with me for 5 seconds. Because what Burry did breaks every rule of how Wall Street normally behaves. The moment Scion's filing went public, analysts scrambled to make sense of it. Hedge funds disappear all the time, but not funds run by the man who predicted the most devastating financial collapse of our generation. Not funds run by someone who only moves when he sees a structural fault line forming beneath the surface. Insiders expected restructuring, a pivot, a quiet rebranding. But what they got was a final, irreversible statement. Scion Asset Management is done. No warnings, no leaked rumors, no transition period. Just a clean, surgical exit. The kind you make when you believe the system around you isn't stable enough to stay in. And here's what truly rattled Wall Street. Burry didn't explain a thing. No interviews, no public justification, not even a vague comment to calm the markets. He simply vanished from the battlefield, exactly the way a man would if he believed the real storm wasn't coming, it had already begun. Now we enter the territory that could change everything for anyone holding AI stocks. If you think this is just another tech boom, click Keep Watching, because what comes next is a pattern older than most investors realize. Michael Burry isn't just walking away. He's sounding the alarm on an entirely new kind of bubble. The same mathematical distortions that fueled subprime mortgages in 2007 and dot-com mania in 2000 are now visible in the artificial intelligence sector, and he's betting billions that reality is about to catch up. Consider his positions. $912 million in put options on Palantir, $186 million in puts on Nvidia. These are not short-term speculative trades. These are multi-year strategic bets, stretching into 2026 and 2027. Burry is declaring that the AI market, as it stands today, is built on the same kind of impossible math he exploited in 2007. Take Palantir, for example. The company trades at a 300 price-to-earnings ratio, compared to a historical market average of 15 to 20. That means for every dollar of profit, investors are paying $300. To recoup the investment through earnings alone, 3 centuries. That is not investing. That is pure hope. Hope that someone else will pay an even higher price tomorrow. And Nvidia, currently with a $3 trillion market capitalization, is another example of the same phenomenon. Burry has publicly accused tech firms of manipulating depreciation schedules for AI server infrastructure. In plain terms, they are spreading multi-billion-dollar costs across unrealistically long periods to inflate quarterly earnings. If Burry's right, the profits driving these sky-high valuations are essentially artificial. And it's not just a handful of companies. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia, collectively exceed $15 trillion in market cap. That's more than the entire economies of China or the European Union combined. 7 companies now claim more economic weight than billions of people producing real goods and services. The bigger problem? Easy money from the Federal Reserve is fueling this bubble. Low borrowing costs push investors into any asset promising outsized returns. Momentum dominates fundamentals. AI stocks soar not because they are profitable, but because the money chasing them is plentiful and reckless. And here's the most dangerous part. This bubble touches everyone. Your 401k, your pension, your college savings plan. Most portfolios are loaded with these overvalued tech stocks because fund managers can't ignore market momentum, even if the math screams danger. This is exactly the type of distortion Burry has historically exploited, but this time he's sounding the alarm instead of profiting quietly. If you're still with me, hit next chapter, because in chapter 5, we'll see exactly how these bubbles burst, who wins, and who loses when reality finally catches up. This is the part most investors never see coming, but it's the moment that decides winners and losers in every market collapse. If you want to understand what's coming next, stay with me. The patterns we're about to reveal have repeated for over a century. Every major financial bubble in history has ended the same way. Smart money exits first, dumb money buys last. And the AI bubble of 2025 is no exception. When legendary investors like Michael Burry step away, they aren't abandoning opportunity, they're protecting themselves. They know that when prices rise far beyond any rational valuation, fundamentals cease to matter. Momentum dominates. The math no longer works. And the moment selling pressure finally appears, a cascade begins that retail investors rarely survive. Look back at history. In 1929, Jesse Livermore warned that stocks had become artificial. Most individual investors ignored him. They lost everything. In 2000, Julian Robertson warned that tech valuations bore no resemblance to rational investing. Day traders mocked him and billions evaporated. In 2008, Michael Burry warned that housing finance was unsustainable. Homeowners called him unpatriotic, and they lost their houses. Now, in 2025, Burry is sending the same signal about AI. Markets have become disconnected from reality. Risk is at an all-time high, and only those who act with foresight will survive. If you're still with me, hit next chapter, because in Chapter 5, we'll see exactly how these bubbles burst, who wins, and who loses when reality finally catches up. This is the part most investors never see coming, but it's the moment that decides winners and losers in every market collapse. If you want to understand what's coming next, stay with me. The patterns we're about to reveal have repeated for over a century. Every major financial bubble in history has ended the same way. Smart money exits first, dumb money buys last. And the AI bubble of 2025 is no exception. When legendary investors like Michael Burry step away, they aren't abandoning opportunity, they're protecting themselves. They know that when prices rise far beyond any rational valuation, fundamentals cease to matter. Momentum dominates. The math no longer works. And the moment selling pressure finally appears, a cascade begins that retail investors rarely survive. Look back at history. In 1929, Jesse Livermore warned that stocks had become artificial. Most individual investors ignored him. They lost everything. In 2000, Julian Robertson warned that tech valuations bore no resemblance to rational investing. Day traders mocked him and billions evaporated. In 2008, Michael Burry warned that housing finance was unsustainable. Homeowners called him unpatriotic, and they lost their houses. Now, in 2025, Burry is sending the same signal about AI. Markets have become disconnected from reality. Risk is at an all-time high, and only those who act with foresight will survive. If you're still with me, hit next chapter, because in Chapter 5, we'll see exactly how these bubbles burst, who wins, who loses when reality finally catches up. History rhymes, and Burry is giving us the verse. He called 2008, walked away at the peak, and millions who ignored him paid the price. Now, he's issuing the same warning in 2025. Markets are disconnected from reality, risk is at an all-time high, and only those who act with foresight will survive. If you stayed this far, hit rewind and share, because this is exactly the moment when ordinary investors realize that legendary warnings are not optional advice, they're lifelines.